Hey, awesome. Well, we will go ahead and get started for our live webinar today. Thanks everybody for joining us. We are really excited. Leverage is something we talk a lot about, and today we're going to hit it head on and really get into the thing about it is I think a lot of people understand what it is, and especially if you listen to us much or you see us much, then it's not going to be something that is new to you. Um, so the real goal of this is we want to define it, kind of start at its basic level. We don't want to take too much for granted. But then what we really want to do is just show the power of what it can do. And if there's one thing that I hear most often as it relates to leveraged type of investing, and that's that it just seems too good to be true, right? And we'll get into that. We're gonna hit that head on because there are things to be careful about with it. But when used wisely, it can just really do some amazing things and again make things look just amplified, right? We're using that word amplified because of what it does. So anyway, smart leverage, amplifying returns with strategic debt. So I'm Rod Zabriskie. We've got Brennan McConnell here as well. We will be your hosts for today's webinar. So let's just jump in first and define financial leverage. So really briefly, it's using debt to create the potential for higher returns in your investing. And I have this cute little lever down here on the bottom, just to kind of show, because we're using a physics term inside of the financial world. And basically what we're doing is we're saying there are ways that we can make building wealth easier. We can amplify things. We can make them better than they otherwise would be if left without the leverage. And so, you have your little fulcrum there, and the bar across the top, and it is lifting that dollar sign. And, with more ease, it's lifting it higher than it otherwise would go if you didn't have it, and using the exact same effort of what you're doing inside of your investing. So then there's this term that we use called conservative leverage. And why do we do that? Because while we totally agree and appreciate the value that leverage can bring to our financial investing, we want to be careful in how we do it. And we'll get into it here in a minute. We're going to talk about some of the benefits and why we feel like leverage is such a powerful tool that can be used in wealth building. And then we're going to give some caution about just some things to make sure you're doing to just be careful. Again, be wise, be smart, right? The term of the thing is smart leverage. Let's be smart in the way that we're using it. So, Brendan, do you want to hit us with the benefits?
Yeah. I'd love to talk about the benefits. I love the benefits, and I'm going to have Rod talk about the cautions because I love just focusing on the good, the upside. So the benefits of conservative leverage, there's a lot of them. One of them being that you're able to amplify the returns that you experience. And part of that is using a smaller dollar amount, and you're getting a much larger return with the smaller dollar amount that you're using because you're getting more out of it. Which leads into the second one, which is asset expansion. Because you're using a smaller dollar amount, because you're utilizing the leverage, you're able to expand the amount of assets that you are able to purchase and go out and invest in, which obviously is going to add a ton of benefit. It's going to amplify the returns. And on top of that, because we're using the leverage, we're also going to get some tax benefits. You're able to deduct the interest on the leverage that you're using. So the funds that you borrow from the bank or wherever you're borrowing it from, you're able to utilize those as a tax benefit in conjunction with other tax benefits like bonus depreciation.
Yep, we'll get into some of the other things, the way that leverage uniquely impacts the tax benefits.
Yeah. So, the next benefit would be preserving liquidity, right? If we're purchasing an asset that's $1 million and we only have to use 200,000, we have an extra 800,000 to go out and invest in other things, right? And have the extra liquidity there in case we need to utilize that liquidity for the asset that we purchase. So it allows us to keep liquidity in our portfolio and invest at the same time by utilizing the leverage. And because we have that extra liquidity, the extra capital, by using the leverage, we're able to diversify a little bit more and utilize those funds to go out and purchase different kinds of assets using different kinds of leverage. And we're able to get, again, a lot more with a smaller dollar amount in a lot of different places, a lot of different assets. Many different deals could be real estate, insurance, and I think those are the two main things that we're covering today. But there's plenty of other places that you can use leverage. And then on top of that, you can actually use conservative leverage to grow your business as well. There are different ways to utilize leverage to amplify returns inside your business. There's ways to utilize it with business planning, maybe utilizing it with like key employee plans or policies. And instead of just having funds that are sitting there maybe in a capital reserve account, maybe we utilize those with some conservative leverage to amplify the returns, grow the business account, allow you to get more liquidity inside of your business, and on top of that, create some sort of tax-free return in addition to that.
Yeah, and I would say in the business topic specifically, there are actually a lot of different ways that we use the term leverage beyond just the financial. Because if you have intellectual property, if you have even just the employees and the skill sets that they bring, you're leveraging those skills. You're paying them for it, of course, but the group together is doing a lot with the leverage that they bring to the table that goes even beyond just the financial.
Absolutely. And then on top of that, it enhances the time value of money. So again, accelerating the returns that we're experiencing in the assets that we're buying, whether it's real estate, insurance, we'll get a lot by leverage, conserve leverage, and
Brennan,
growing our wealth that way.
we're using a little bit, so I'm just gonna jump in on this one a little bit, because the idea is that if we're getting better returns, that matters today. And one of the things we're going to hit on big time with this is what happens with that over time. Because if I get a better return, I'm happier now, right? But when you expand that over time and you say, okay, but over the next 10, 20, 30 years, what does that look like? What's the difference between having used it, again, not just today, but over time? What does that mean in terms of building the wealth? And so that time value of money really, really kind of shines as it relates to that. Okay, so with all that said, with all the rosy part of that, let's just talk about cautions. Because again, when we're talking about amplifying returns and all this kind of thing, it comes with some risk. There's added risk involved when we add leverage to the investing that we're doing. And so I'm going to hit on the first one: keep ample liquidity. This is the antidote to almost all risks as it relates to leverage. Because if I get into a pinch, but I have cash somewhere that I can bring into the table and kind of relieve that stress for a little bit, then usually what happens is once we get past those stressful situations, then things get a lot better. For example, with interest rates having done what they've done over the last year, 15 months, and the stress that's put on a lot of the investments. So for right now, what's the antidote to that? Well, potentially you may have to put additional cash into the plan to keep it going, because the idea is if I can keep it going and I can get to a place where, well, the fact is rents are going higher as well, right? So if for the short term I'm in that pinch, but if I can get past it and I can enjoy the result of higher returns, even if interest rates stayed higher, but I have more income that I can then use to offset the higher interest that I'm paying. And if it takes a little bit of cash of me putting into it in order to create that extension to allow me to get there, then things get much better. So anytime you're using leverage, and I would say this includes if I'm investing in a real estate syndication or something else where leverage is being used by the provider, the operator, then I need to come in expecting not only, well, basically it's two things. Number one, I need to have realistic expectations in terms of the time frame on when I can plan on getting my money back. If their projection says 2 to 3 years, I always plan on 5 to 7. Okay. Just from a planning standpoint. But on top of that, then I also want to make sure I have liquidity so that if it comes down to it and there's some sort of capital call or something, then I'm ready to jump in and kind of do my part, so to speak, to keep things going, to get it to a better place. Okay. The second piece I want to talk about is just because you can doesn't mean you should. And the big example on this one is if you go back to 2008, really what kind of created that scenario was people's access to loans, to debt. And for a little down, or in a lot of cases, zero down, being able to go out and buy a property. And because money was so readily available, it also, that's basically what pushed up prices, because if I can get into a property with little to nothing down, and so I buy it, the next person can do the same thing, that creates a lot more demand on that property, and that pushed prices crazy high, like just nuts, like someone, buying a property one day and a month later selling it with a 25% profit or more. And so, but then what happened is when the crash came down, the values also came down as well. So if you had bought that property with 0 or maybe 10% down, but the value went down by 20%, now you're upside down. And if you don't have the liquidity, so again, these two are going to go hand in hand. If you don't have that liquidity to kind of stave off the problems for, in that case, most likely 2 or 3 years, then a lot of people went bankrupt. So, and I wasn't a real estate investor at the time. I was just a lowly homeowner trying to make ends meet. And when I saw what was happening, I was really surprised by what banks were willing to do in kind of offering the types of loans that they were. And I wasn't interested. So in other words, you would go and pre-qualify for a mortgage, and they would say, based on your income, you can get this much of a loan. And when I looked at that number and the not just the total debt, but the monthly payment that came with it compared to my income, and I'm like, that just seems crazy that I would do that. And there were a lot of reasons that they were saying that you should do it. But to me, it just felt like too much. Like I just wasn't comfortable taking that on. And that's a good thing I didn't, because I bought a home in 2007 and we bought less than we wanted. We bought a fixer upper. We had to put money into it to get it up to where we wanted it to be. But I was really glad that we did, because when 2008 came along, my business went under, and I had to kind of scrape things together for a little while, and we were able to stay in our home, and everything was good. Because so did we use leverage? Absolutely, right? We got the loan, we just didn't go crazy with it. So just kind of a tale of caution as it relates to that. And number 3, really important, is to understand the risks. So if you're looking at an investment and they're touting all of the benefits, the great things about it, and either they're not touching on the risks or they're just brushing it over it lightly, then it behooves you as a potential investor in the course of doing your due diligence to understand what those risks are. If it looks like there are no risks, keep looking deeper. If you feel like you understand the risks, again, keep asking questions, make sure that you understand, because that leads to a key, so that, well, number 1, keep ample liquidity. What's ample? Well, you will know the answer to that question once you understand the risks of what you're getting involved with. And then 4th, diversify the risks. So Brennan talked about one of the benefits of using leverage is that we can diversify across multiple properties with the same dollars instead of putting it all into one. And so when you're doing that, just make sure that you're diversifying risks. And the thing that we see most often as it relates to this is people who get in their mind that there is a single best investment that's out there. And while that may be true, so for an individual, I do believe that they're based on risk tolerance and goals and all these kinds of things, that there is an investment type that's better than others. But having said that, I don't believe that people should be getting into a situation where they're putting everything into that one investment. So, and the reason is because, again, it comes with risk. And if you're putting everything into the basket with that carries all that same risk, and something happens that stresses that risk, then everything you have is subject to that. Whereas if you identify what you're investing in based on risks and you're diversifying your risks, then when something happens and it impacts a portion of your portfolio, the other things, because you were thoughtful and basically the kind of the balancing risks, so to speak, so that the other part of your portfolio does fine and at the very least isn't subject to the same problems, but even in some cases, hopefully it benefits from it. So example, interest rates go up dramatically over the last year plus. Well, if you were to the extent that you have used leverage, then you're burdened by that higher interest rate. But to the effect that either the investment you're in is impacted and return gives you a higher return as a result of the higher interest rates, and or you have other investments that are built to give you better returns when interest rates are high, then it balances that risk. So just make sure that in the spectrum of the investing that you're doing, to diversify your risks. And then finally, the last caution I want to talk about is to start smart. And this may go without saying, but just don't bite off more than you can chew, and or align yourself with people who have experience, who know what they're doing. Their track record is good. You can trust their judgment, whether it's in a partnership mode or like a mentorship type of role, to kind of, as your starting point, be at a place where you can be comfortable with the added risk that you're taking on by using leverage. And if you'll do that, if you'll do all of these things, then leverage is not something to be afraid of. It's not something we have to hide from and be scared of. We just have to plan accordingly. Do the things we're doing in a way to take advantage of all the benefits that Brendan talked about, while not letting it kind of drive us down. Okay, so with all that said, that's all the kind of the precursor, because what we want to do next is we have a couple of examples that we put together where we show leverage in action, and we're going to show basically person A versus person B. Person A is investing in the exact same asset, but they're not using leverage, versus person B who is using the leverage. So first, I want to do a real estate example. And so here are our basic assumptions. We're going to be buying a $700,000 multifamily property. Okay. And that's going to produce $10,425 a month of rental income. For this example, we're going to hold it for 10 years. And in reality, you would probably do some different things in the interim, like a refinance or some different things. We're just, to keep our example simple, we're just going to assume that the rental income stays the same, that we're just holding it for the 10 years. And when we have a 10-year loan on the example of the person who's getting the loan, et cetera. So we're just kind of keeping it simple, even though in reality, most likely you would do other things to even increase the return. For the property itself, we're going to assume a 5% annual appreciation on the property. And then finally, at the end of the 10 years, when we sell it, we're selling it for $1,150,000. So it's basically the $700,000 at the 5% appreciation compounded gets us to the $1,150,000. Okay, so let's look at the comparison between the two. So person A on the left, they're buying the full property outright. So I mentioned the $700,000 property. They also have closing costs. They have real estate fees to pay. And so their total out of pocket is the $736,000. Person who's using leverage got a 20%. They had a 20% down payment, and they got an 80% loan for the rest. And so all in, their total was $147,000 out of pocket. When it comes time to now say, okay, well, you bought the property, now you're taking in the rent, you have costs, et cetera. What's the net income that's coming in on the person who's not using leverage? Their net income is $9,225 per month, where the person who's using leverage is $2,389. And you might say, well, man, $9,200 sounds a lot better than $2,300. And you're absolutely right. But when you look at it as a percentage of what they had to put in, then the income on the person who's using leverage is actually higher. So in other words, as a percentage of what they put in, it's a 12.5% annualized return for the person who is not using leverage versus a 16.2% for the person who is. And again, this is after all costs. You paid the mortgage, you paid property taxes and insurance and all the different things, maintenance costs, and this is what you end up with as the net income. And then what's going to happen is when we fast forward to the end of the 10 years and we have sold the property, the person that didn't use leverage, their net gain was $414,000, which not bad, right? I think a lot of people would feel pretty good about that, unless you compare it to the person on the right who had a $1 million net gain at the sale. And what's interesting about this is, maybe it's obvious to people, but the way I think of it is, the reason why there's such a big difference there is that the person who used the leverage, the bank isn't an equity partner, right? You're using other people's money to make the purchase. And over the course of the 10 years, you paid off that loan. I aligned it perfectly so that it was a 10-year time frame and a 10-year pay down of the loan. So they didn't have any loan to pay off. So they walk away with the full equity. They didn't have to share that equity gain with the bank. It's all theirs. So again, going back to the whole lever example, with the same amount of effort, you can raise that dollar sign higher because of the leverage. You got a lot more out of it because all of that equity gain came back to you. Okay, I see questions starting to come in, and I'm grateful. Please do start to throw questions in there as you have them. I will defer to the end and then come back and answer the questions. But Greg, I see it and I appreciate it. And so, yeah, anyone else, as you have anything come to mind along the way, jump into the Q&A section there, drop in your question, and then at the end, we'll come back and answer those. Okay, so the next piece on here is in the end, what was the actual rate of return that they received? When you take all things considered, the income they received, the extra gain that they got off of it in the end. And for the person who did not use leverage, it's a 13.5% rate of return, which again, in comparison with a lot of things out there, that's not bad, right? And I'll also say this, the one thing that we didn't, again, I wanted to keep it relatively simple. I did not include all of the tax benefits in terms of doing a 1031 exchange at the end, or the bonus depreciation, or those kinds of things. In this example, we actually paid the capital gains tax in the end. We weren't, again, trying to get too fancy with it. Both of the returns that we're going to show here would have been amplified by those benefits as well. But since we're focusing on leverage for this example, then I wanted to keep it relatively simple. So the 13.5 there, but when you talk about the return on the leverage side, it would have been a 22.6% annualized rate of return for the person who used the leverage. And you may look at that and say, that's great, right? I would rather have the 22 rather than 13. And I certainly would fit in that category. And then you might say, okay, but that's a 9% difference. That's good, right? But remember in the first slide, in the benefit slide, when we talked about the impact of it on the time value of money? Well, let's look at that really quickly, because the 147 at 22.6 versus the 736 out of pocket at the 13.5. Let's see what that looks like. So when you expand that out, and I'm not using just the 10 years, I'm saying if over time in this example for 30 years, you were able to maintain that same type of return on those initial dollars, then what would you expect to see, right? So let's start with the kind of tannish line there, the 736,000 at a 13.5% rate of return over 30 years would take you to 29 million. And again, who wouldn't be happy with 29 million, right? However, if over the same time frame, you could have started at the 147 and with a 22.6% return, turn it into 54 million. Okay, very different. And in saying this, I totally acknowledge we're not going to be in a situation where we're getting the exact same return every year. You'll have some years where it's higher, like the 5 years prior to last year, 30 to 40% returns was not unusual. And you'll have times where you have a lesser return and maybe even some losses in there. So it's not necessarily a smooth line. But if between today and 30 years later you say, well, I averaged a 22.6% return, then that turned a much smaller number into a much bigger number than what the other person had who started with the 736. But when Brendan was talking about this, he said, I'm using the 147,000, but that doesn't mean I'm just letting the rest of my money sit on the sideline. I'm using leverage, so I'm going to go out and invest in other things. And so, what if we made it more of an apples to apples? And we said in both cases they were investing a starting point of 736,000 and comparing them, and the difference is enormous. So going back to just the core difference between the percentage rates, a 9% difference. Well, 9% is not nothing. It's something. But just at its core, would you expect that over 30 years, that would result in a 10x difference? So if we start at the same 736,000 and you grow at the 13 and a half, you ended up at that 29 million, like we mentioned before. But if you have the 736 and you're increasing at the 22.6 compounded, that's $272 million. Again, 10x is the difference with that 9% difference when you compound it over time. And so, again, going back to what I said earlier, is this too good to be true? It's not. There are people right now who are doing this and much better than this, and have consistently over time, and will continue in the future to consistently do stuff like this. And using leverage makes the difference between, in this example, extended over time, 29 million over 30 years versus 272 million. Again, a 10x difference. So again, let's be careful with it. Let's use conservative leverage. But if you do it, it just, the difference is enormous. Okay, Brandon, anything else you want to say on the real estate example before we jump over into the next one?
No, I think you covered it. I think that's
Sweet.
great. Yeah, I mean, it's just a huge difference spreading out the 736. If you use leverage or if you don't use leverage, there ends up being such a huge difference. And that's, again, because you can diversify into a bunch of different assets, get a bunch of different assets producing cash flows and incomes. And over a 30, 40-year time frame, it's pretty amazing.
Yeah, for sure. Awesome. Okay, well, why don't you walk us through the next example with the capital avalanche?
Absolutely. And if my connection comes through not good, just take over for me. Hopefully it comes through strong.
Okay, little shaky to begin with, but go for it, and we'll see how it
Okay.
goes.
All right. So with the capital avalanche strategy, many of you listening to the call may be familiar with what we're doing here with the capital avalanche. But let me go through the assumptions first. So on the one hand, we're going to show $100,000 a year going into life insurance policy for 10 years. And we're using a traditional life insurance retirement plan, which is traditionally going to be an indexed universal life policy, or an IUL. And we're going to do the same thing, kind of a person A, person B example, where person A is not using leverage, person B is going to be using leverage. But again, the assumption is 100K for 10 years using this exact same policy. But one's going to be using leverage, the other is not. So we're going to look at creating retirement cash flow. This is kind of the objective of the policies. We're creating tax-free retirement income and cash flow. So we're going to look at that on the one hand, what the leverage does there. On top of that, we're going to talk about the estate planning benefit, because there's a couple of different phases that these policies have. The first phase is creating and generating that tax-free income. And then after we're done taking that income, we're getting towards the end of the life, it then becomes a very big piece of estate planning and a huge benefit in estate planning. So the assumption on the individual is going to be a 46-year-old preferred non-smoker, which just means fairly good health, not the best health, not the worst health, but pretty good. And we're going to start these policies at the age of 46.
So before we jump into the person A, person B, maybe we want to give them a little more context on, again, what the capital avalanche is and kind of how it works, so that then when we do the comparison, it'll make a little more sense.
Yeah. So the way that the capital avalanche strategy works is utilizing leverage to accelerate the returns in the life insurance policies. So, as an example, if we're putting 100K into a policy, I would put the 100K into the policy the first year. And then starting in year two, I can actually go out and use leverage to start funding that policy with 100K every year in perpetuity. So I can keep building on top of that. So I only put in the 100K once, and then I'm going to use leverage to continue putting in the 100K. So in this example, where person A is going to put in 100K on their own for 10 years. In the second example, I'm putting in 100K every year for 10. On top of that, I'm going to be stacking policies. So I'm going to start a new policy each year with 100K.
Okay, your connection's a little bit jumpy right now, so I'll just pick up. So the 100,000 inside of the capital avalanche strategy, when you put the 100,000 in year one, in year two, from year two onward, for those same policies we set up, we're going to be financing 100,000 a year going into them. And then in year two, we're going to start up new policies, and the individual puts in 100,000 to get the new policies going, and then in subsequent years, financing the premiums moving forward. So in the example where we're using the leverage, the individual is still putting 100,000 a year in for 10 years, but what's happening is we're stacking this capital avalanche plan so that by the end of the 10 years, we actually have 10 policies, 10 sets of policies in place. And in reality, because we're now financing all the future premiums on each of those new ones that we set up, we actually have $1 million a year going into the policies by that point in time. So the individual has put in a total of $1 million, 100,000 a year times 10. And that's true on both sides, whether you use the leverage or not. But on the side with the capital avalanche, we've created a scenario where we have 10 sets of policies at 100,000 years. So we're getting $1 million a year into each of those policies. So again, when we get to the numbers and you think, man, it just seems too good to be true. Well, think about it in terms of that, the difference between the person who was not using the leverage and has 100,000 year policy, just one policy, versus a sequence of policies at $1 million a year going in, and the difference that makes. All right. So now let's talk about what kind of comes from that. So as Brennan mentioned, the initial benefit that we're talking about here is what's happening in terms of income that we're able to create. And starting at age 60, we start the income. We take a snapshot at age 65. On the non-leveraged side, we're looking at $102,000 of income coming out versus on the leveraged side, $320,000 of income. When we fast forward to age 90, the non-leveraged side is still the 102. So it's just a level 102 a year for between 60 and 90. Whereas with the leverage, because of the leverage, we're able to increase the amount of income we're taking out every year. In other words, when I talked about that $1 million a year of money going into it, that continues. We just continue leveraging that. And going back to our core of this idea of conservative leverage, we're doing that in a way where we're building an asset with those dollars. And simultaneously, we have this loan that is doing the most of the work in terms of building the asset. So we do have a loan outstanding, but the asset, the value that we have in the policies is always larger than what we have as a loan. Even when it comes to the point where we're taking the income out, we keep a very sizable buffer between the cash value balance and the loan balance, because going back to what we talked about earlier, our cautions, we need to keep a certain amount of liquidity, and we build that into the plan so that internally it can take care of most situations. Certainly historically, any situations, the plan by itself would be fine without any contributions from the outside. So we, again, kind of practice what we preach, right? Keep liquidity to keep it going. When you get past the tough times, things get even better. And then over the long term, we are assuming that our average growth inside of the policies is roughly 2% higher than the average interest that we're accruing on the loan. And so that arbitrage creates it's that leverage that working for us that creates these benefits. And so you think about inflation, right? Between the age of 65 and 25 years later, when you're 90, does the cost of living go up from 320 to 1.9? Maybe not, but you also think about healthcare needs and other things that kind of the unknowns of what may happen. So that increase of income because of the leverage is a huge part of this. So in the end, when we look at the total income received on the person who was not using leverage, 3.1 million total for those 31 years, versus having used the leverage, 27.2 million of total income. And then when the person passes away at age 90, on the non-leveraged side, there's an additional 248,000 of death benefit that pays out, while there's an additional 24.4 million of death benefit after having paid off the loan. What was left remaining of the death benefit is 24.4 million that goes to your heirs at age 90. And so the total between what you took out in income over those 31 years plus the death benefit is huge. And so 3.4 million on the non-leveraged side, 51.6 on the leveraged side. So in terms of like an actual return, what that result comes out as is 5.4% IRR with the policy. And that's consistent with what we talk about, right? If you heard us talk about the investment optimizer or any other kind of just what's realistic to expect inside of a life insurance policy in terms of the return that I'm getting, 5.4% is totally in line with that. But what if by using leverage, I can take a 5.4% producing asset and turn it into something more? So the return that I get, the return that I see, because most of the money went in there was other people's money, what was the return that I got? And it's roughly 14% in this example. So again, difference 5% to 40% or to 14%. And you look at the difference there, right? Let's look at it on the graph. So the difference between the 3.4 million of growth with a 5.4% annualized return versus 14%. And again, it looks amazing. It looks crazy to think about. But in reality, and I'm actually going to reference back. So while I was going over the previous example in the real estate, Paul jumped in and made a comment. He said the 9% improvement from 13 to 22 is actually a 67% improvement on returns. In other words, you take what's the difference between 13 and 22? Well, it's 9%, but of the 13%, 9 is 67%, right? So in this example, if I turn my 5.4 into 14, I almost tripled it. Right. Double it would have been a 10.8, so I almost tripled my return. So again, even though it's a roughly 9%, 8.5% difference between the two, the result is enormous. So if, as you're looking at this, or if you've looked at Capital Avalanche in the past and looked at the total of the numbers over 44 years in this example, and you said, man, that just seems crazy. How do you turn, instead of the 3.4, how do you get 51? Well, hopefully this helps you see, because by using leverage, still in a smart way, but in a powerful way, and you extend that over time, the delta just is enormous. Anything else you want to say on that, Brandon, before we jump back and kind of do a summary?
Yeah, I would just quickly add that 14%, and both those returns, the 5.4 and the 14, those are tax free as well.
Yes.
So it's pretty close to in line with the other real estate example.
Yeah, it's a great point, because if you have 14, depending on your tax bracket, what does that become if it's tax free? Well, maybe somewhere around 20, 22, right? So yeah, it's absolutely a great point. And very key to the additional benefits that we get because life insurance is the asset that we're using on the leveraged example. Okay, so let's do a quick summary here and talk about some of the highlights. So at the top there, conservative leverage is kind of the term we've been using. We use very frequently. That turns into strategic debt. Again, we're using the debt. We want to use leverage, but we want to do it in a smart way. We want to be strategic in the way we use it. So that's kind of what conservative leverage is doing for us. How does it amplify our returns? Number one, it creates a higher return. Number two, there are more tax benefits. I talked earlier about how we didn't have to share the growth in equity with the bank. Same thing on the tax benefits. When you go and you do your bonus depreciation, when you do a 1031 exchange, et cetera, you're just paying off the loan. You don't have to share those extra tax benefits with the bank. And so if it's the difference between 147,000 of tax benefits versus 700,000 of tax benefits, I'll take the 700,000 and I get them all. If I use the leverage and used other people's money to amplify that. Third, a larger asset base. We talked about that. We just are able to create more assets. We have our dollars working in more places to build up our asset base, which leads into number four. That gives us greater diversification, the ability to do greater diversification. We have to choose to do it, but we can diversify those risks. And then in the end, it just leads to a larger estate, more wealth that we've been able to build by using leverage conservatively in a strategic way. And so we're just better off because of it. So, okay, so that is what we had prepared. We would love to answer any questions that anyone may have. You can drop them into the chat. You can go to the Q&A and drop them in there. We're going to start with Greg Bray, who says, how do the return calculations change if you take the down payment money as a loan against a life insurance policy where you also need to pay that back? And it's a great question. I've seen many examples of this where you're getting a traditional loan for the 80%. So in this case, you're going to come up, you need to come up with $147,000 down payment. But instead of just, having that sitting in the bank account, if you're using the investment optimizer strategy, you have your opportunity fund in the life insurance policy. So what Greg is describing here is, if instead of it being just a cash out of my pocket down payment of the 147,000, if instead I'm taking a loan against my life insurance policy and using that for the down payment, then what happens? And at the end of the day, if you do that, you're using 100% of other people's money, right? And so that can amplify the returns even more. Now, you need to run the numbers, because in this example, would the $2,500 of my net monthly income, would that be enough to pay the loan on the life insurance and feel like I'm, number one, at least keeping up with the interest? Well, yes, I would at least be keeping up with the interest and also be paying down the principal. Well, based on those numbers, yes, I would also be paying down some of the principal. I'd have to run the numbers to know whether or not I have that paid off by the end of the 10 years. But certainly it would be, based on these numbers, it would be something that would absolutely work. So if I don't need that $2,500 of net income coming in, if I'm not using that somewhere else, then doing what you're saying, using the investment optimizer loan to pay for that down payment would absolutely be a way to amplify the return even better. So great point. Okay, I hit on Paul. It was one who made the comment about the 9% improvement is actually a 67% increase in the actual return. And then he also gives an example. He says, like, the delta between going from 1% to 2% doesn't seem like much, but you doubled your return, right? Going from 1 to 2, you doubled your return. And so going off of the rule of 72, you end up doubling your money in 36 years instead of 72 years with that quote unquote small of a change. So yeah, great comment, Paul. Appreciate that. Next, we have Julian, who says, what may be the risks for the capital avalanche regarding future term insurance cost? It's a great question. So when we build life insurance inside of the capital avalanche strategy, we're building it in a way where we minimize the cost in order to maximize and optimize the cash value side of the growth asset side of it. And so in doing that, it is true to say that as you get older, the insurance that we're carrying in the policy gets more expensive. However, expensive is a relative term, right? Because if you look at it, the amount of cost relative to the asset that you have that's growing year in and year out, then the expense is actually getting lower. Or in other words, if I look at the amount of expense I have in year one relative to the amount of cash value that I have there, then it might be 20 to 30% of a cost, right? Well, as we know, the life insurance policy costs are heavily front end loaded, and so those costs are getting lower. But then when I fast forward and I'm 80 years old, and for the insurance that I'm carrying on the plan, the cost that I'm incurring is going up each year, but now my asset is huge as well. So as a percentage of the asset, the actual cost is a fraction of a percent, 0.003% or something of the actual asset. So the question is fair, and it really just goes back to the way the policy was created. Especially within IUL, I personally would not want an IUL policy that was not max overfunded, because then I am potentially in a place where those rising costs and later in life could come back to bite me. But in the way where we're doing it, where really like the core insurance part of the policy only accounts for 10 to 20% of the kind of quote unquote premium that I'm putting in. In other words, I'm overfunding it by multiple times versus what the minimum would need to be if I was only caring about the insurance side of it. Because of that structural piece, it just makes it so that when I get to those later years and the higher costs matter, or higher costs are happening, it just doesn't matter as much because I have this huge asset. I can take on many, many years of the market being down and not getting the growth, and still be fine without any concern for losing the policy. But it's a great question. Okay, and if there's anything else, let me know. If not, then it's been great being with you. Thank you all for joining us. We will have a recording for this that we'll make available for anyone who would be interested. And thanks for joining us for this webinar on smart leverage, amplifying returns with strategic debt. Hopefully it's been helpful to see not just theoretically that using leverage could make a huge deal in the way that we build wealth, but really seeing some examples, seeing the impact of it over time, so that we can do it in a smart way, still being aware of the risks that we take on when we use debt, and planning accordingly with leverage, with those other pieces we talked about, but really using it to our advantage to just create more in the long term than we could without it. Okay, thanks everyone for joining us.